This segment sponsored by Foster Financial. Welcome back. It is time for another Money Monday with Foster Financial. And joining me today is Vice President Caleb Doan. Hi.
Hi.
Good morning.
Good morning.
How's it going?
It's going well. Yeah. How are you doing?
Doing good. The year is rolling.
Yes.
We're in the middle of tax season. I know that so much is happening. Last week, we talked about required minimum distributions. And now we're going to piggyback on that topic today. So what will we discuss?
Yeah. So I know on some of these Money Mondays, we kind of like to focus on topics that apply specifically to women.
Yeah.
And one of the things that we talked about a little bit last year is, on average, women are typically a little bit more charitable minded than men. We're all thankful for the nice, generous ladies out there. But we've noticed, a lot of women are donating, tithing to their church, whatever it might be, every single year. And so one of the strategies that we talked about last year was, if you're over 70 and a half years old, we always love those little half ages, of course. If you're over 70 and a half, you can donate directly from your pre-tax account, usually an IRA, donate directly from that to a church or a nonprofit organization, and then it comes out of that account completely tax-free.
Okay.
And it actually helps satisfy your required minimum distribution, too. So if you kind of took our advice last year, looked into that, maybe you did some of those qualified charitable distributions, you want to make sure that you keep track of how much you donated over the course of the year from the IRA to those organizations.
Yeah.
Because you're going to get a form in the mail. It's a 1099-R form, and it's basically going to say, hey, you took out, $10,000 over the course of the year from your IRA. Now, if all of the money that you took out went to a nonprofit organization, then that's pretty easy. You can just tell your CPA, hey, all of this went to a nonprofit. If only part of it did, though, you want to make sure that you get that kind of ratio correct. And so you can tell your CPA, hey, $5,000 went to a nonprofit, $5,000, I took out and used for daily living expenses.
Okay, but so I want to take a different turn because we've talked about this, and this is such an interesting topic, but I want to dive deeper into how people can really tangibly do the donations. And so we talked about nonprofit. So this applies to any nonprofit, any 501c3 out there, not just churches. So people can find organizations that they care about and they can give their money. There is a minimum that they have to do, right, for the donation?
So there's a minimum that the government forces you to take out of your retirement account starting at 73 years old. But once you're over 70 and a half, there's not a minimum that you have to donate. Okay. So you could donate $5, $10, whatever you want, all the way up to $100,000 is the maximum that you can do with qualified charitable distributions.
Okay, and then is there a certain amount that you have to donate in order to get the tax benefit, though, at the end of the year? Because sometimes when you file your taxes, you see the question, okay, is it over 10,000? Under, does the tax services give you a natural deduction? Right. That little qualifier that sits in there?
Yeah, that's a great question. And this is a good distinction to make, because I think some people think, wait, can I still take the standard deduction while I'm donating with these qualified charitable distributions? So it's kind of two different areas of the tax form a little bit. So normally, if you're just donating to a charity from your checking account, you'll keep track of how much you donate. If the amount that you donated is less than the standard deduction, then you're just going to take the standard deduction, right?
Okay.
If the amount that you donated is more, which this year the standard deduction is $29,900 or something like that, right around 30 grand. If what you donated is more, then usually you can itemize your donations and you get to take more than what the standard deduction is. A qualified charitable distribution is kind of something totally different. Qualified charitable distribution is where we actually give you a checkbook to your IRA and you write a check to a nonprofit organization. Since it's coming directly from your IRA, normally money that comes out shows up on a different line on your tax form, and it'll say, hey, Susie took out $10,000 from her IRA, you need to tax this. Instead, it comes out completely tax-free. And so on the line it'll say, hey, $10,000 came out, but none of it is taxable. And so the nice thing is you can donate from the IRA, get the tax benefit by it coming out tax-free, but then you can still take the standard deduction and still get that, 30 grand for a couple filing, married filing jointly, they can still take that standard deduction.
So it sounds like it's so important to weave this through an IRA and not directly from your account in order to get the tax benefits.
Yeah, that's the thing. Like usually if you're under 70 and a half, almost, and this isn't in all scenarios, but most of the time you would have to donate more than what the standard deduction is to get any sort of tax benefit.
Right.
Unfortunately, I mean, most people are donating for, more altruistic reasons than just to get the tax benefit.
Yeah.
But with QCDs, you get a tax benefit right away, even if you're just donating $5, let's say.
Okay. And this still applies to people who are pre-retirement age, correct? Because we talked about, what did you say, 70 and a half?
Yeah, 70 and a half is when
and
you're allowed
above.
to do
So
this,
people could still be working. You can still have an IRA when you're working. Of course, anyone can set that up. So really, most people have access to this. It sounds convoluted in ways, but most people can actually set this up with a financial advisor.
Yeah. If you're over 70 and a half and you have a pre-tax retirement account like an IRA, this is something that's open to you, and it's a really great thing to take advantage of.
Yeah. And what would you say is the biggest way that this type of QCD impacts someone's taxes?
Yeah, so I mean, normally somebody would be taking, let's just say $10,000 from their required minimum distribution. If they're in the 22% tax bracket, they're paying, $1,100 in taxes on that. And then maybe they're also just writing a check from their checking account to their church for 10 grand.
Yeah.
They don't get to itemize, so they're not getting a benefit there, and they're paying taxes on that money that comes out of their IRA. Instead, if you just kind of cut out the middleman and you write the check directly from your IRA, you no longer pay that $1,100 in taxes. So it's a nice little top of the line tax savings right there.
Right there.
Yeah.
Okay, well, thank you so much, Caleb, for breaking that down.
Yeah, you bet.
And remember, Foster Financial is dedicated to helping women plan for retirement. We will have their phone number listed below. Give them a call, and we'll be right back. This segment sponsored by Foster Financial.